Hello, this is Tim Kelly from the LTC Collaboration, and thank you for joining us today. The LTC Collaboration is conducting a series of interviews with industry experts regarding the pricing of long-term care products being sold in the market today. Prior to starting our interview, I would like to briefly describe the new LTC Collaboration service if you're not familiar with it. The LTC Collaboration is a portal dedicated to agents and brokers across the country who find it difficult to keep up with all the different types of LTC products available in the market today. It's a place where you can see the unbiased reviews of LTC products from other brokers. Think of it as the Yelp for LTC products. Right now, we have to rely on the biased marketing materials from the carriers, which always places their product in the best light. The reviews on the LTC Collaboration, however, are the unbiased opinions of independent brokers just like you. The only obligation to joining this new service is to do a product review yourself. Please go to the website at ltccollaboration.com that you see on your screen, where you can watch a demo of the service and join. Today, my interview is with Marc Glickman, who is the CEO of BuddyINS.com. And we're going to be discussing the Society of Actuaries long-term care insurance pricing project that was completed in 2015. Marc, how are you today?
I'm doing well, Tim. I love what you're doing with this LTC collaboration project.
Thank you. Thank you. Can you give us a little background on yourself for our viewers who don't know you?
Yeah, so again, my name is Marc Glickman. I'm an actuary by background, but I have the unique experience of actually working with a lot of the top specialists, long-term care specialists in the industry today. So I have a technical background. I was involved in pricing products. I've done studies of the experience that we're going to talk about today. But in addition to that, I actually work with the top specialists, and I understand how they offer the products today in a way that gets their clients comfortable around getting a solution that's really customized to their needs.
Fantastic. So let's just get into the pricing project a little bit. And can you, first of all, just kind of give us a summary of the project and what the authors were trying to accomplish with it?
Yeah, so over the last several years, the long-term care market has changed quite dramatically. You know, back in the 80s and the 90s, the products were priced based on assumptions, based on disability marketplace, because there wasn't a lot of experience in long-term care. They based it on population data, so statistics about the national nursing homes in the country. And as the marketplace has evolved, of course, now the products provide home health care coverage, assisted living coverage, and so the marketplace has kind of changed quite dramatically from what those original assumptions were based on. So what the SOA wanted to do is they wanted to compare assumptions from different pricing eras, because we know that the products have become more conservative on pricing. We wanted to figure out, what does that mean for the future outlook of how the products are going to perform, whether the prices are going to be stable or whether they're more likely to have rate increases.
So one of the things that we want to try to accomplish today is to try to get some information to the brokers out there across the country who may have over time grown to distrust traditional long-term care because of some of the rate increases that have happened in the past. But now we have a lot more data so that we can price these products more appropriately. So I think the first piece of data is in regards to interest rates. Can you talk to us a little bit about what we know about interest rates and how the product's pricing has changed over time?
Yeah, and I want to say first of all that what's really important is to get a client a solution that meets their needs. So I'm not a believer in traditional or hybrid products. I'm a believer in long-term care planning. And the fact is that insurance can be a good solution for a lot of people for their plan. So interest rates affect a lot of different products. The lower interest rates are, the more expensive products are, because the insurance companies, they accumulate money to pay for those future claims. But it also creates a more difficult scenario for the clients to self-fund the risk, because the lower interest rates are, the less they'll get on their own investments as well. So they're kind of related to each other. Now, the good thing about lower interest rates is that it creates a more conservative pricing structure so that it's less likely that there will be a future rate increase. And the reason for that is the lower that interest rates go, obviously the less likely they are to decrease further. When we're thinking about today's very low interest rate scenario, the insurance companies feel very comfortable about where they're pricing interest rates because they're basing it on today's interest rate environment, but playing out over the next 50 years. So again, if they're not concerned about the likelihood that interest rates are going to decrease, then you shouldn't be as concerned for your clients that the likelihood of the rates going up is going to be higher. So when we look at the pricing study for the year 2000, they assumed around a 6% rate of return on investments. If you look at the pricing study as of 2014, the interest rate assumption that was used was about 4.6% for very long duration investments. If you look at it today, it's probably even lower still. It's probably about 3.5%. So when you look at the pricing today, that should give you more confidence that the rates will stay stable because, again, they can't decrease as much going forward.
Great, great. Thank you for that. And so I know one of the other variables that had a big impact on pricing over time were the lapse rate assumptions
Yeah.
of long-term care insurance. Can you tell us a little bit about that?
Yeah, so I'll say the number one reason that created the need for rate increases was a interesting factor that more people held on to their policies than the companies expected, which if you think about it is actually a good thing. People valued their policies, they didn't drop it. Even when there were rate increases, people continued to pay the extra premium because of how much value they got from the policies themselves. And for that reason, the insurance industry as a whole paid out more and expects to pay it more out in claims than they were expecting because there's more people around. So it used to be, let's say in the year 2000, that they assumed that 3% of people were going to lapse their policy, meaning that they were not going to renew their policy each year. So 97% of people were keeping their policy every year, which in the insurance industry is incredibly high retention rate, renewal rates. Well, it turns out that 99.5% of people kept their policies every year. Now you might think 97%, 99.5%, that doesn't sound like a big difference. But if you compound that over 30, 40, or 50 years, there's probably going to be 2 to 3 times as many people that end up on claim because they kept their policies than what the companies expected. And for that reason alone, they had to increase the premiums, maybe even double what they were originally pricing it at because there were more people to pay out those claims too. Now, the good thing about assuming a 99.5% persistency, people keeping their policy every year, is that, well, we can't go above 100%, right? Yeah. Most of the people that can keep their policies 100%. So we consider that the pricing factor to be de-risked, meaning that there's no risk of a future rate increase based on lapse anymore because we're virtually assuming almost everybody keeps their policy now.
Right, right. Great. So finally, I think one of the last things that really impacts the pricing, of course, is claims data. And so can you tell us a little bit about the claims information that we have now versus 2000?
Yeah, so that's the last factor. I would say once you take away interest rates and persistency rates, the last factor that you have to price is the claims. And that's both in terms of frequency, how many people go on claim, and severity, how long those claims last. That's the factor for long-term care. And it turns out actually that the assumption for frequency was better than expected originally in 2000. So actually fewer people went on claim, especially from those companies that did more prudent underwriting. Okay, and most of the industry today is a very prudently underwritten product. So they're actually able to pretty well control the number of people that they expect to go on claim. What turned out to be not as favorable was that people are actually going on claim for longer than what they expected. People are living longer, they're having more issues like Alzheimer's, and the claims duration is tending to be longer. So the industry has kind of priced in those more modern severity assumptions, the length of claim assumptions into their products, which also means that it's more conservative. And the regulations are such that now they actually have to price in a margin on top of that. So the regulators want the carriers to be more conservative. They've actually enacted rate stability regulations, and those are designed to make it less likely that the carrier needs to do a rate increase going forward. So from that perspective, we have more control. It's really driven by underwriting first, but there's more data available as well, and we have more certainty over what we expect from a claims perspective.
So when we look at those three variables, the interest rates, the lapse rates, the morbidity or claims information that we have, we've gotten that much more correct today, almost as you say, have de-risked that pricing. Tell us a little bit about that margin you just mentioned, because in addition to just getting the pricing right because of that new information we have, we're actually putting more of a pad on top of that just to make sure we don't get it wrong.
That's right. The PAD is actually an actuarial term, believe it or not. It stands for Provision for Adverse Deviation, PAD. And
Okay.
what they do is they actually add on a 10% or maybe even a little bit larger load factor beyond what the actuaries expect their best estimates to be, just to have an additional conservative viewpoint. So if we're wrong, then we have some additional margin to absorb being wrong on the assumptions. So it creates more of a likelihood that we're going to estimate this correctly, and more importantly, that you're not going to experience a future rate increase. Now, one of the, I'll say, conclusions from the study, one of the more important conclusions is what they did was they looked at all the assumptions, and they assumed if we know what we know now going forward, and we run some testing as to what's the likelihood of a rate increase. So they ran a number of simulations as part of the study, and they determined that there's only a 10% chance that the product's price today will need a future rate increase ever. Okay,
Wow.
so 1 out of 10. And
Okay.
if it were to happen, if that 1 out of 10 were to happen, the average rate increase amount would be about 10% as well. So what that means is that not only are we less likely to have a rate increase, but if it happens, it's also going to be less severe. It's not going to look like the rate increases you saw in the past.
And so I recall one of the things in the project was that they actually compared that to the chances of a rate increase back in 2000 and 2007. What did those look like?
Right, and what they were assuming is back in 2000, if we knew what we knew then, okay,
Yes.
so assuming we don't know how interest rates turned out in this low interest rate environment, but they
Right.
were, again, more aggressive with the assumptions because the regulations required them to be more competitive to drive the prices down, and so there was a good rationale for that, but there was probably a 40% chance that the products, knowing the assumptions they knew then would need a rate increase. Of course, a lot of those assumptions turned out to be faulty, and it turned
Right.
out to be that almost every product needed a rate increase. But if you look at it as if what we know now, that 40% has come down to only 10% likelihood going forward.
Great. That's fantastic. So I know one of the additional things that we should talk about is the amount of data that we actually have today versus when we were pricing products back in 2000. Can you talk about that a little bit?
Yeah, one of the things in the actuarial world that gives us more comfort around what we're assuming going forward is how much data we have to back it up. And as we talked about back in the early days when the product was much newer, they just didn't have a lot of actual experience with what happens when you sell an insurance product in this market. So if you look at the data in 2014 compared to 2000, there is 16 times more policy data, which helps to give us certainty around some of the assumptions like the lapse rate assumption while the policyholder is currently paying the premium. But more importantly, there's 70 times more claims data today than there was back in 2000. And what that means is, the more data you have about the actual claims behavior, the more comfort you have around those frequency and severity numbers, which really drive your results. So that's one of the bigger reasons why that percentage likelihood of a rate increase has come down, is we just have more certainty around the possibility of future outcomes because of the data.
Great. So as we finish up, Mark, is there anything in terms of the brokers out in the marketplace today and giving them some comfort, some level of trust in traditional LTC pricing today? What would you say to them?
Yeah, so one of the things that I talk to the top producers about is I don't like to tell stories to clients. I don't like to explain this technical aspect to clients. They want a simple answer that they can feel comfort in. And really what the simple answer is that there is a lot of different product solutions out there if you ask questions of it. In fact, a lot of the carriers, now there's a few carriers that are allowing you to prepay the premiums. So you can create a guaranteed premium for your client if you want. Again, if the companies feel more comfortable, that translates to product guarantees. Sometimes I'll tell producers, we'll just budget in a 10 or 20% rate increase from the outset into the product. Save that money like you're self-funding it in addition to the insurance product. And if it turns out there's no rate increase, the client gets to keep that money. So there's a lot of ways to position where you're under promising and over delivering. And so you don't have to just take the carrier's word for it or the industry's word for it, but you can actually design protections in it for yourself so that your client's going to have a good outcome and you're going to be the hero advisor or agent for them.
Great, awesome. Well, Mark, thank you very much for your time today. Is there anything else you'd like to add about the project?
No, just if you're interested in this, I'm sure Tim and I will be doing more collaboration on this. I love the LTC collaboration. BuddyINS.com is a website where we're going to help people that are believe in long-term care planning do marketing for themselves and for their clients. So again, if you're interested in that, just go to that website, and I'd love to kind of talk to you guys more about what we can do to help you out.
Fantastic. So thank you for joining us today, and stay tuned for more interviews from the LTC collaboration posted on the website and on social media. Thank you again, Mark.
Thanks for having me, Tim.
So long.